At 8:47 on a Monday morning, the bank manager looked at the family's balance sheet and smiled. "Congratulations," he said. "You're worth 4.8 crore rupees." The father smiled back. His wife did too. Their apartment was worth 2.6 crore. They owned a second property worth another 1.5 crore. Their car was paid off. They had some investments, gold, and savings. On paper, they were wealthy. There was just one problem. They had $18,000 in their bank account. And rent, school fees, loan payments, insurance, groceries, electricity, and taxes were due that week. They weren't poor. They weren't exactly rich either. They were something much stranger. They were asset-rich and cash-poor. And that distinction can completely change what wealthy actually means. Because a person can own millions of rupees in assets and still feel broke every single month. And sometimes, the richer they look on paper, the more fragile their life becomes. Let's call this family the Sharmas. The Sharma family looked successful from the outside. Mr. Sharma had worked for the same company for nearly 20 years. His wife ran a small home business. Their 2 children attended an expensive private school. They lived in a large apartment in a desirable neighborhood. There was a second property too. That property had been purchased years earlier for 70 lakh rupees. Now, according to the latest market prices, it was worth around 1.5 crore. That sounds like an incredible investment. And technically, it was. The family had gained roughly 80 lakh rupees in paper wealth. But there was a catch. They didn't receive 80 lakh rupees. Nobody transferred 80 lakh rupees into their bank account. The property simply became more valuable. And that difference is where the story gets interesting. Imagine you own a house worth 1 crore. Someone tells you tomorrow that the house is now worth 1.3 crore. You are 30 lakh richer. Congratulations. Now try paying your electricity bill with that 30 lakh rupee. You can't. Try buying groceries with it. Still can't. Ask the property for $5,000. The property remains completely silent. This is the first illusion of paper wealth. An asset can make you wealthy without making you liquid. And liquidity is what pays the bills. The Sharma family discovered this slowly. At first, rising property prices felt like winning. Every few years, their net worth increased. 1.2 crores, then 1.8 crores, then 2.7 crores, eventually nearly 5 crores. Friends told them they had made it. Their relatives asked how they had become so wealthy. But something didn't match the numbers. Their monthly income was about 1.8 lakh rupees. That sounds comfortable. Until you look at the expenses. School fees, home maintenance, insurance, food, transportation, utilities, taxes, family obligations, and, most importantly, debt. Because the family had borrowed money against the second property. The loan had helped them renovate the house and make several investments. When interest rates were low, the payment seemed manageable. Then borrowing became more expensive. Suddenly, the same family that looked worth nearly 5 crore rupees was watching its monthly cash flow like a hawk. This is where net worth becomes a dangerous number to worship. Net worth is simple: assets minus liabilities. If you own 5 crore rupees worth of assets and owe 1 crore, your net worth is roughly 4 crore. But net worth doesn't tell you whether you can survive next Tuesday. It doesn't tell you whether your income covers your expenses. It doesn't tell you how quickly you can sell your assets. And it definitely doesn't tell you whether selling them would destroy the lifestyle those assets created. This is the part people rarely include in conversations about wealth. The difference between being wealthy and looking wealthy can be enormous. Consider the family's second property. Everyone counted it as 1.5 crore. But suppose they suddenly needed money. They couldn't simply walk into a bank and say, "Please give me 20 lakh rupees from the value of my house." Well, technically they could borrow against it, but borrowing creates another liability, and selling creates another problem. The property might take months to sell. There could be transaction costs, taxes, brokerage fees, legal expenses, and price negotiations. The 1.5 crore headline number is not the same thing as 1.5 crore sitting in cash. This is why economists and investors care so much about liquidity. Cash is boring, but boring is useful. A liquid asset can be used quickly. An illiquid asset can be extremely valuable while remaining practically inaccessible. And the Sharma family had another problem. Their lifestyle had grown alongside their paper wealth. When their apartment increased in value, they felt richer, so they upgraded the car. Then came better vacations, more expensive restaurants, a larger renovation, a bigger school budget. None of these decisions looked outrageous individually. That was the trap. Lifestyle inflation rarely arrives wearing a villain costume. It arrives as a reasonable upgrade. It's only another 8,000 rupees a month. Everyone in our circle has one. We can afford it. And technically, they could. Until they couldn't. The family wasn't spending money because they were irresponsible. They were spending because their financial situation looked stronger than their cash flow actually was. And this is where the story becomes bigger than one family. Because modern wealth increasingly lives in things that fluctuate in price. Homes, stocks, businesses, land, private companies, digital assets. When prices rise, millions of people suddenly appear wealthier. But when prices fall, something strange happens. The wealth doesn't just shrink, confidence shrinks with it. Imagine the Sharma family's 2.6 crore apartment falls 15%. That's a decline of 39 lakh rupees. Nobody took 39 lakh rupees from their bank account, but their net worth just changed dramatically. Now imagine their income stayed exactly the same. Their expenses stayed exactly the same. Their loan payment stayed exactly the same. Only the asset price changed. This is why paper wealth can create a psychological illusion. When asset prices rise, people feel richer and often spend more. When prices fall, they feel poorer. Economists call part of this the wealth effect, and it can influence entire economies. Rising house prices can make homeowners feel financially secure. That confidence can encourage borrowing and spending. Banks may lend more because collateral appears more valuable. Investors become more optimistic. Businesses invest. Consumers spend. The cycle feeds itself. Until the direction changes. Then the same mechanism works backward. Asset prices fall. Collateral becomes less valuable. Borrowing becomes harder. Spending slows. Confidence disappears. And suddenly, the person who was worth 5 crore rupees doesn't feel wealthy anymore. They feel trapped. There is another uncomfortable detail. Some assets are valued based on what someone might pay for them. That doesn't mean someone is willing to pay that price today. A house can be worth 1.5 crores because similar properties sold for that amount. A private business might be valued at 10 crores because an investor bought a small stake at that valuation. A stock portfolio can rise by 20 lakh rupees in a month. But none of that guarantees the owner can convert the entire amount into cash at the quoted price. Markets are constantly creating numbers. The human brain then turns those numbers into feelings. That can be dangerous. The Sharma family eventually faced a decision. Their second property was becoming a burden. The mortgage was expensive. The rental income wasn't enough to cover all the costs. The family had two choices: keep the property and continue squeezing their monthly budget, or sell it and give up the asset that had made them feel wealthy for years. They chose to sell, and something unexpected happened. They became financially healthier. Not richer, healthier. The sale released cash. The expensive debt disappeared. Monthly expenses fell. Their emergency fund grew. Their financial life became less impressive on paper, but much more stable in reality. Their net worth dropped. Their stress dropped even faster. And that is the paradox. Sometimes becoming poorer on paper can make you richer in real life, because wealth isn't just about how much you own. It's about how much control you have over your money. Can you handle a 6-month loss of income? Can you pay an unexpected medical or family expense? Can you survive higher interest rates? Can you avoid selling your investments at the worst possible moment? Can your lifestyle survive without constant borrowing? Those questions don't appear on a glossy net worth statement, but they may matter more than the number at the bottom. The Sharma family story isn't an argument against property, or stocks, or investing. Those assets can build extraordinary wealth. The problem begins when we confuse valuation with financial security. A 5 crore net worth sounds impressive, but if 4 crore is locked inside a property, 80 lakhs is tied up in investments, and monthly cash flow is negative, the person may be far more financially vulnerable than someone with a smaller net worth and strong liquidity. This is why 2 people can both be called millionaires and live completely different financial lives. One has assets, the other has options, and options are often the part of wealth nobody talks about. The ability to walk away from a bad job, the ability to survive a recession, the ability to wait instead of selling, the ability to say no to debt, the ability to handle a surprise without turning it into a financial emergency. That's real financial power. The Sharma family still owns their apartment. They still invest. They still earn money. But they stopped asking one question: how much are we worth? Instead, they ask a more uncomfortable one: how long could we live if everything suddenly went wrong? Because maybe the most misleading number in personal finance isn't your salary. It isn't your savings. It isn't even your debt. Maybe it's the number that tells you how rich you are without telling you how free you actually are.